Belated New Year, everyone. Thank you very much for joining this webinar. Over the next probably about 45 minutes, Ray and I are going to talk to you about annual employer reporting requirements. Specifically, we're going to hopefully give you a bit more clarity around it, give you some war stories or examples of what we've seen over the last year, and provide some guidance around the general reporting requirements. This is not meant to be a technical session, so we're not going to tell you exactly how salary is going to be reported or benefits are going to be reported, or which boxes to put them in. What the aim of this webinar is more to give you an overview, a flavour of what your obligations are, what areas we see or we have seen in the last year that have gone wrong for certain clients or for prospects, or in general comments or discussions that we've had. And probably more importantly, what the implications of those are and how you can effectively address those or what to think about. So today, there's two of us speaking. Myself, my name's Adrian. I am from the UK originally. I have been practicing global mobility and anything to do with employees for the last 20 years, 10 years in London for Grant Thornton, and the last 10 years out in Singapore. And I lead the employee solutions practice over here. Rian is joining me and he'll be speaking later. He is doing exactly the same thing as me, but purely based in Singapore. He's done it for professional practice firms like ourselves in the Big Four, as well as in-house roles as well. So going on to some general housekeeping first, as we have more people join. This webinar is recorded. And it is only meant to be a guide, so we can't give you specific advice, partly because advice will generally depend on the facts and circumstances, and that may vary depending on your business, the exact nature of payments made to people, even those individual situations as well. So hopefully you'll get a good overview guidance, but if you need further advice, then go speak to your advisors or reach out to one of us afterwards. As this is a recorded webinar, afterwards we will be making available the recording and slides, and they should be sent to you hopefully in the next week, if not earlier than that. As we go through, I said we're going to take around hopefully 45 minutes. But after that, we will be around for some question and answers. So if you have any burning questions that you have, feel free to put those in the Q&A chat box. If you've got any technical, not from a tax perspective, but technical from a Zoom place, there is a chat function that you can speak to our marketing team and they'll hopefully be able to help you. So in terms of our agenda, I will already mention it very, very briefly, but we're going to give an overview of your obligations as an employer. Then we're going to dig into or dive into some areas that we saw in 2024 from our clients and from not our clients, in terms of what we saw was underreported, or questions around or trying to gain clarity on what they should report in certain scenarios. And there are themes year on year, but generally they are relatively similar. So I wouldn't be surprised if these themes carried forward to 2025. And then the third part will wrap up effectively going through, okay, now you've realized that, or you've spotted something that you may not have done correctly. How do you resolve this with IRAS in the least painful way, so to speak? And then as I said, we'll go through some Q&As after that. So to start off with, just to make sure everyone is listening, we have a quick poll question to see how confident are you that your employment income reporting is complete or correct. So hopefully you'll have a poll up which you can click on confident, not very confident, or never thought about it. And if you're very, very confident, then maybe you can switch off after the poll session. But hopefully you'll keep listening to see whether your confidence is valid, or maybe you need to rethink that or relook at it afterwards. So I see that we've had around 40% of the people participate, so we'll just give another few seconds before we close it off and see what it looks like. So let's close it. So we'll end the poll and we will show the results of the poll. So it looks like just over half of the people listening into this are very confident that you are complete and correct with your employment income reporting, and that is great to hear. About a third aren't very confident. So it sounds like you know that there may be something that might not be done correctly, or you just don't know what is right and what is wrong in every manner. And about 12% of you have never even thought about it, which is understandable to a certain degree. Singapore is a simpler jurisdiction than others. So with simplicity, some people never think about it and just assume it's going to be easy and done correctly, which is always a risk. So moving on to the next slide. I'm going to go through a very quick refresh of your general obligations as an employer. And then Rayon is going to go into specifically the forms IR8 and IR21, which are specifically for IRAS. So as I'm going through a high level, IR8 and IR21, which Rayon would go through in more detail, are the two forms that you would submit to IRAS. IR8 is due every year, which is due by 1st of March. So most of your businesses will be busy either collating information or starting to prepare these forms for submission to IRAS. And it's generally for all of your employees. The IR21 piece is applicable to any non-Singapore citizens, generally if they're leaving more than 3 months or they've ceased employment. And we highlight this because this can be due at any point during the year. It's due usually a month before the individual leaves. And it also requires you to withhold all payments due to that individual until you've received a tax clearance directive from IRAS. So I said, Rayon will go through those in a bit more detail shortly. The other aspects that you need to be aware of in terms of payments as an employer is CPF and Skills Development Levy and Self-Help Group. So the CPF side of things is a bit like our Social Security in Singapore. It is only applicable to Singapore citizens and permanent residents, and there are both employer and employee contributions. I think the most important piece around CPF is there have been changes made to CPF rules over the last couple of years, where effectively the ordinary wage ceiling has increased year on year and increased again in January this year. And that we have seen lead to some issues and errors, both from a payroll perspective, when calculating the monthly amounts. So some people have forgotten to apply the new rules, and also from an annual perspective, because the OW ceiling does impact the AW, the additional wage ceiling, which is more typically reserved for bonuses. So we've seen some errors creep in or some misunderstandings creep in as a result of that. So it's just making sure that you're on top of those pieces. The SDL and the self-help group are smaller amounts, which we won't go into great detail. And the self-help group is more of a charitable donation based on immigration, religion, and ethnicity. So thinking a little bit further afield in terms of your obligations, I think probably the first thing to look at is where a company has an interaction or a relationship with an individual, a working relationship, you need to identify whether you actually have an employee or whether they're self-employed or whether they're a director, and how that fits into the tax rules. So just because you call someone a director doesn't mean, or sorry, let me rephrase that. Just because you call someone self-employed doesn't mean they're self-employed. You'd actually have to look into the relationship between yourselves and them to determine whether they are really a self-employed individual or they are an employee for the tax filing obligation rules and the CPF obligation. The slide here we've picked up on, if they are not an employee, so IR8 generally doesn't apply, IR21 generally doesn't apply, there is still something that you need to be aware of as an employee, is probably the wrong word, as a business, where you make payments to non-resident self-employed individuals, you may need to withhold taxes from those payments, and that is due, as it says, within 15 days of the payment. So, as Rayon will go through later, and we wanted to reiterate it, when you report for income and benefits, you need to make sure that you report all gains and profits, whether it's cash, non-cash, whether it's paid from Singapore, paid from overseas, whether it's paid by you as the business or whether it's paid by someone else, maybe a group company. If it's all related to your employment, you need to consider it, unless, as it says there are concessions or exemptions available. So then, if you don't do things correctly, there are penalties for non-compliance, and those could range from penalties for incomplete returns or late returns to even companies having to pay the taxes on behalf of individuals. And I guess the final piece, which we haven't covered here, but I think Ray will cover a bit more detail, is there can even be jail time for directors or people responsible for certain obligations. So these aren't light penalties, so just have to be wary of. And then the last point is, as we'll go through later, when you have identified errors, one of the ways that you can use to mitigate penalties is a voluntary disclosure, and we seem to be seeing more and more of those voluntary disclosures being made to IRAS at the moment. So something to consider, shall we say. So with that, I will hand you over to Raymond, who'll go through IR8 and IR21 in a little bit more detail.
All right, thanks, Adrian. Hi everyone. So this is Raymond here. So this webinar, we will be delving into the technical aspect of performing a deep dive in terms of how to prepare the returns. We did an in-depth session last year, so we'll be sharing a link for you with you. And you can refer to it afterwards after the webinar. So what we'll focus on in this session is really in terms of providing you with a clear understanding, right, in terms of your obligation as an employee when it comes to the Form IRA and obviously the IR21. So this should hopefully help you navigate through your responsibility confidently and how do you go about making sure that you're in compliance. So what is a Form IRA? So this is the return of employee remuneration, all right? It is a very important form that you need to prepare and issue to your employees, okay? What goes into the form? All right, this includes all income like we talked about earlier, cash, okay? Includes all cash payments, any benefits provided to you in kind, includes equity compensation, gains from the stock options, share awards, your discounted shares to your employees when they participate in the employee share purchase plan. And it also will have to include what you deduct from the employees from a CPF perspective and from a self-help group perspective. So the question obviously is, then who do we prepare the forms for? So it includes all your employees. It's your full-timer, your part-timer, your contract workers, and includes also your employees who are usually based overseas but are currently in Singapore providing services or are working on projects in Singapore. So, or employees who have ceased employment with you, but you still continue to pay them, okay? And this could be like trailing bonus, trailing commission payments, or anything to do with their Singapore employment period. So, but this doesn't apply to people who are subject to tax clearance. I will cover that when I talk about the IR21. Okay, so, and of course, also if you make payments to your directors, to your board members, and or if you provide any benefits to them at all right, you have to prepare the Form IRA for this group of people. So it does sound like we need to prepare for everyone. Not really, because there are people who will be excluded from the reporting requirement. So that will be your non-Singaporean employees whereby tax clearance are applied. So, well, non-Singaporean employees includes your Singapore PR. So Singapore PR permanent residents are also subject to the Form IR21 rules. Okay, so if you have prepared a Form IR21, okay, no additional income is paid to them, okay, then you can exclude this group of people from the IRA, okay. Or if you have employed employees directly in Singapore and you post them out immediately and they don't provide any services in Singapore at all, these are actually excluded from your reporting here in Singapore. So for the reporting period is, you know, we all adopt a preceding year basis of taxation. So it includes your employment earnings derived from the preceding calendar year. Okay. So now, yeah, moving on. So I thought to share just a summary just for ease of reference when you're looking at the slide after this webinar is, many of you here will be working in companies whereby you have more than 5 employees, but some of you here may be working in companies where the headcount is under 5. So in Singapore, when you have more than 5 employees, you need to register for what we call an auto-inclusion scheme. In short, we call it AIS. So the difference is people who are not on AIS, all right, you need to prepare and issue the Form IRA and send it to issue them to your employees by the 1st of March every year. Okay, for people who are on the auto-inclusion scheme, you make a direct transmission to the IRAS by the 1st of March. Okay, so it is important to know how do you report the compensation or benefits. So in general, all the cash items that you pay to employees goes onto the Form IRA. Benefits in kind gets reported in the Appendix 8A, and then for equity compensation, that goes into Appendix 8B. So where there are situations whereby you pay excess CPF contributions, right, that actually goes on to a form called the IRAS. We rarely see that because most of you here would have a payroll team doing your payroll reporting or engage a payroll vendor to help with reporting. So I usually don't see a lot of SF CPF contributions within our clients. Now, moving on to the Form IR21. So Form IR21 is also known as the tax clearance return. Okay, this is another important form that employers need to know when and how to file. So this is required, okay, when you have foreign employees ceasing employment. So like I said earlier, non-Singapore citizen, then so that includes your Singapore PR. So this can mean employees who have resigned, okay, or are transferred out of the company to another country, okay, or are leaving Singapore for an extended period of time. So when we talk about extended period of time, the IRAS will tell you at least anything more than 3 months. That's considered extended period of time. There are exemptions available. Okay, say for example, if a Singapore PR ceases employment with you, then the resignation, but will be joining another company in Singapore and will not be leaving Singapore, they can be excluded. The IR21 following requirement can be waived, subject to them issuing you with a letter of undertaking, saying that okay, they're not going to leave Singapore, they will remain responsible for the taxes that arises from their employment with you. So, or it could be reasons whereby you are sending your employees overseas for training purposes, nothing exceeding 6 months, and they'll still come back to work after they complete their training. This group of people can be excluded from the IR21 filing as well. So a lot of the times when clients come to us, I would say, always make a proper assessment, okay, whether or not the employees qualify for the exemption that the IRAS talks about, because there could be situation whereby we make assumptions that, hey, we should be able to qualify for the exemptions, but actually the employees don't meet the relevant conditions to be exempt from the IR21 filing. So important to take note is, if your employees qualify for the waiver, as in the IR21 filing requirement is waived, it doesn't mean no filing. It means that when it comes to the year-end reporting, okay, you have to include their income in the Form IRA. Right? So reporting period, okay, it will be for the income, employment income derived in the year of cessation. Okay, a few things happen when a clearance requirement is triggered. You need to apply what we call a deemed exercise rule, okay, on equity compensation granted in Singapore. So equity reporting is always an area that can get quite complicated, especially for private companies. So we did a session last year on this as well, and we'll share the link with you so they can look at it for more details. Happy for you to come to us if you do have any specific situation to discuss with us. All right. So one important point that employees should always remember is the moment you are aware of your employee ceasing employment with you, you need to withhold monies. All right, from the moment you are aware. All right. So yeah. So it's always a problem when there's immediate termination or teams are not updated of staff movements. Okay, and then following due date, you need to file the Form IR21 at least 1 month before the date of cessation. Okay, cool. So before I move on to the next section to talk about other stuff is, we probably don't hear enough or see enough on the news whereby we see employees getting penalized for non-compliance. We see a lot on other people getting prosecuted for other tax offenses, but not really on the employment income reporting space. So just want to highlight to you, there are definitely consequences for non-compliance, and these are in the act. So if you file returns late, okay, the risk is IRAS can impose a fine on you. Not filing at all, okay, it's offense. Okay, you can be subject to fine. Okay, if you don't pay the fine, you may be sent to the prison. Okay, and obviously, in situation whereby you file incorrectly or incomplete returns are submitted, okay, the risk is penalty plus a fine and possible imprisonment. In the past 18 years, I've not seen anybody getting thrown into jail for not reporting an employment income tax. So probably it's there, just to highlight that it's there. So if they want to, they could do that. But I think as most of us would try, okay, our best, if we run into non-compliance, we try to make sure that we take corrective actions to be compliant going forward. But obviously that is a very painful thing to do, to right a wrong that we did in the past. Okay. Now, move on to our next poll question. So when was the last time that you have conducted a peer review? Okay, some of you may be currently going through one now. Some of you may do it within the last 2 years, 2 years ago, never, or don't know what exactly this is all about. Very interesting results I'm seeing. Yeah, I think we'll close the poll for now and we'll share. Okay. Okay. So let's see. 32% of the participants here today are actually going through one peer review. I would say it's a good thing. Okay. And I'll explain why later. Okay, there's a small group that has never or don't know what the peer review is. Never mind, we can talk about it. Or you can approach us to find out more. So I will just carry on with why I wanted to ask this question. Okay, in recent years, okay, there has been a lot more inquiries coming to Adrian, coming to me from clients and prospects. And a lot of them come to us not because they want to, but rather they needed to. And the reason is really simple, because IRAS went knocking on their door. So in many of these cases that we have dealt with, most of them come to us telling us that, hey, IRAS knocked on my door. They told me that I didn't do things correctly for one items. Then obviously when we go through the situation with them, we ask a few more questions, we realize that what a lot of them don't realize is it's not just one error they've gotten wrong. Okay, it's actually it's a number of items that they may have not gotten it correct right at the start. So this is something that Adrian will cover at the later part of the session now. So in 2024, we saw an uptick in terms of people coming to us. So on this slide itself, it's just some of the common items that were brought to our attention. So obviously, I don't have all the time in the world to go through every single one of you, every single one of them with you. So what we do, we just pick up a few and just throw in some examples so that you have an idea in terms of what IRAS has been asking. Okay, so one of the items that we always cover and has always been a challenge to many employees or companies is when it comes to the reporting of benefits in kind. Okay, why is this challenging? Because it can be very broad, and it also depends on how much companies are willing to give as benefits to employees, right? We have seen in news companies giving up free holiday to Tokyo Disneyland, bring the whole family and all. We have seen people giving up gold bars, expensive watches for long service awards, so on and so forth. So do they know exactly how do you report it? Okay, what's the tax and CPF implication of it all? So if you have attended our sessions in the past, one of the common items that I always talk about is all on rate packets, and it's always during this time of the year, so I definitely bring on rate packets. So rate packets, I've talked about it so many times, but people, you'll be surprised that there are still people not reporting it for CPF purposes. And not only that, a lot of people may report it for CPF purposes, but not for tax purposes, because they think that, okay, Rian said, well, ang pao is subject to CPF. He say it's not subject to tax. Not exactly true, because IRAS concession when it comes to rate packet is anything not substantial in value. And when they say that, they mean anything under $200. So there are companies that gives out rate packets like $500, $600, $800. Those are not reported, and we actually saw that happening with some of our clients or people who came to talk to us. We also had an example whereby a client of ours in the retail space, okay, in retail industry, that provides discounted goods to their employees. So they thought they did correctly, okay. They had an internal process to review to say, oh, it looks like we qualify for the concession, and whatever discount that the employees actually enjoyed shouldn't be taxable. So when we had a conversation with them, then what they didn't realize is, well, they tried to follow the rules, okay, but they didn't quite align how they value the goods, okay, according to IRAS guidance, and that led to a series of errors that need to be amended. Okay, so one other thing that happened last year, the year before, was there was a lot of scrutiny around the kind of travel benefits that was that are being provided to employees. Okay, for example, we have a case that Adrian may cover in detail later, an airline company offering discounted flights or free flights to their employees. The client actually didn't know how to report it correctly, because, well, first of all, the pricing for air tickets can be quite dynamic. Okay, and then what the client didn't do was there wasn't a proper tracking in place to actually track what kind of discount the employees were actually enjoying. In the first place, they don't even know how to value, okay, the flights that they were offering to their employees. Therefore, this actually didn't get recorded at all. So we went in to help them to come up with and liaise with the IRAS to agree on a certain position to take for this group of people, and they help them with the voluntary disclosure. Okay. Then one last thing on BIK, benefits in kind, is on there is obviously a big trend on offering flexi benefit scheme. Okay, last year I covered that in great detail. So for those of you who are not familiar with flexi benefit scheme, so this is a scheme whereby the company come with a budget every year to say that, well, each employee has a budget of, say, up to $2,000. Okay, you can use that $2,000 for anything that you want to do. Okay, it can be subscription for gym membership, used to pay for your child's education. Okay, you can use it for optical purchases, medical product purchases, so on and so forth. Okay, what happened, or the challenge with offering this scheme is companies do not actually track what kind of reimbursements are being made, or what reimbursement are actually what claims are being made by the employees. So the check that they do is, well, the budget is $2,000, right? As long as you don't cross the budget, I don't have to do anything. And they also take a very naive assumption that IRAS guidance is always, as long as it's available to all, high chance it should not be taxable in the hands of the employees. Not exactly right, because we really need to look at the type of benefits that the employees are getting reimbursement for. Okay, so it is very easy to choose the easy way out, and then afterwards find that you have gotten things wrong and then try to rectify it. Okay, so on flexi benefit, one of the most common things that we see is reimbursement for medical expenses, but how they categorize medical expenses was too broad. Okay, so getting reimbursement for seeing a doctor because you're ill, okay, that is not taxable. But using the flexi benefit scheme to buy vitamins, all right, that is actually, or buy a device to track your heartbeat. Okay, if you buy a Fitbit, all these are actually not exempt from tax. Okay, all these are actually taxable benefits. Okay, there is another item that always gets to us, and that is equity compensation. Adrian,
Yeah.
talk about it.
Sure. So I think from an equity compensation point of view, we've had a number of clients approach us to understand how equity compensation is taxed, especially since, you know, a lot of these equity compensations are granted by overseas companies, maybe a US or UK headquartered companies. So not the local team may not be or may not have complete oversight on that. But the one I wanted to bring out was one of our clients had an RSU scheme, which is a type of equity scheme. That RSU scheme also paid dividends or dividend equivalents, and they actually approached IRAS 3-4 years ago and asked them whether they needed to report. IRAS said no, not taxable, dividends not taxable, equity not taxable, so they did not report. 3 years down the line, they thought, let's check again. So they asked IRAS again. This time IRAS said taxable. So then they went, I've had one IRAS officer say not taxable a few years ago, one IRAS officer now saying taxable. So then they approached us and asked us, can you review the equity scheme? Can you give advice? So going through that, we identified both the dividend equivalent and the RSU were taxable. And as a result of that, we also asked them, do you want us to look at your wider reporting, payroll reporting? So having looked at the wider payroll reporting, unfortunately, equity was not the only issue. There were other items, benefits and kinds, some of which Ryan's already discussed, that were taxable and weren't reported, either because they hadn't got the tracking mechanism in place, or they had treated medical too broadly, as an example, or they just weren't aware of some of the rules that had applied to it. And, you know, it's not uncommon. Those of you who are going through payroll reviews, hopefully you won't have any or too many, but Singapore being simpler in tax, these errors can creep in and because they're not looked at frequently, they can exaggerate over the number of employees and the amount of time that it takes to catch these. So that's why we brought up the earlier question as how frequently or when was the last time you conducted a payroll review? Because even though you do one, it's very easy for errors to creep in, especially if you have new payroll items or new benefits coming in or new rules coming into benefits. We've seen the tax rules for benefits change over the last few years, and there are consultations in place to change some of the tax rules on benefits going forward as well. So it's not just the case of we've done a payroll review today, we're fine, or we're going to correct it. You have to have an ongoing process of making sure that you are on top of it and accurately reporting. So yeah, equity compensation is one of the biggest issues I come across with my clients at the moment.
Yeah.
Ryan's going to cover one more.
So maybe I'll just cover one more item which I thought was a bit of an interesting, which I think is a bit of an interesting one, is during the course of 2024, we were approached by a number of companies, all right? So they didn't know what they, so what I want to talk about is actually about the loans to directors. Yeah, so loans to directors. So we were approached by a few companies. Some of them are actually not our clients, all right? They just come to us because they realized that they needed help in terms of understand what should be reported. So what they didn't know they were doing is they were actually, in essence, providing a loan of sorts to their directors. So all these companies who approach us, they're all in different industry, not related at all, is the situation goes along the line in terms of the directors of the company, either through a corporate card or through disbursement from finance team, uses the amount for his or her own personal expenditure. We have seen them using it for renovation purposes, going for holidays, so on and so forth. Okay, there wasn't any agreement in place that this is a loan. Okay, there wasn't any proper documentation to say that this is a loan or verbal agreement, verbal conversation to say that it is loan. But there was a common understanding that this is an amount that the directors, okay, will need from the company for personal expenses and will be paying it off. But obviously, when you ask more questions, realize that, well, It just so happened that the directors just continue asking for disbursement and not really making any payments, and making any repayments towards the loan he or she has actually obtained from the company. So the failure to actually recognize that this is actually a benefit in kind resulted in underreporting of the remuneration paid or provided to the director. And actually, as we are speaking, we are helping one of our clients to do a voluntary disclosure on this to the IRAS. So Adrian talked about this consultation in terms of updating the rules for certain benefits. Loan is actually one of them. But there is a consultation to talk about loan to employees, because right now, if you're talking about loans to employees, if it's available to all employees and you meet certain conditions, actually that isn't really a taxable benefit. So there's a consultation happening. We don't know when this will be finalized, that this may potentially be removed. So if you are offering loans to your employees, this could impact you in the near future, which is why having a periodic review helps in terms of making sure that you remain compliant, up to date with your understanding of the current regulations. So if and when we hear from the IRAS, we will provide an update to our clients and our contact. Now, I am going to pass this back to Adrian to continue.
So the next section is really, if you have uncovered errors, what should you do? What are your options going forwards? So this is just a very high level slide in terms of some of the things that you could think about doing. Calling IRAS may or may not be the best idea. Do nothing, again, may or may not be the best idea. So there's a number of options that you have there. My next slide is going to be a poll question, and then after that, I will go through some of the steps that we generally see and we would generally recommend taking, as well as some options in terms of how you can take that forward. So let me move forward to the poll. Again, you should get a poll coming up saying, when was the last time you did a voluntary disclosure to either IRAS or the CPF board? And completely understand, we haven't really gone through CPF or talked about CPF in great detail. And that's another whole ball game. We've focused mainly on IRAS for now, because I think that is where we typically see the voluntary disclosures. But we do also see CPF challenges as well. Okay, so about half of us have responded, so we'll end it and see what those responses are. So there's a higher number than I thought that are currently going through one or have done it. About half of the people here have never gone through a voluntary disclosure, which is great to hear. Hopefully you never have to. And about five or so people aren't sure, just fine. So interesting to know. So, okay, you've realized that you've either misunderstood the tax rules or your processes weren't tight enough and you've come across an error or an issue. So what should you do, or what are some of the steps you could do? And apologies, this is a slightly small slide, but hopefully you can see it and follow through it. So starting at the top, the first thing you should do is assess where you are. Find out what the nature of those errors are, find out the extent, how many people does it cover, how many years, who it covers, and if it's the only issue or are there multiple errors that you've uncovered. Then I would always recommend you speak to an advisor. I wouldn't necessarily recommend making a decision and going to IRAS or either as a voluntary disclosure or other means. I'd speak to an advisor to take advice. The advisor, depending on your guidance, may recommend, and it's up to you whether you do one or not, a further internal or an external. So the advisor like us, we can do a payroll review to delve into it in more detail, to do a proper full-on review to identify, is what you've assessed the only issues or are there more issues to uncover? Then after that, we've outlined two routes in this slide. One is a very simplified method and one is the more formal voluntary disclosure. And again, it's up to you as a business which one you choose. There are risks and benefits of going down the simplified route. Benefit being it's more simple, as it says on the tin. The risks in terms of the voluntary disclosure does allow you to mitigate some of the penalties that Rayan alerted to earlier, whereas a simplified one doesn't necessarily allow you to do that. But it is simplified, it is simpler. We'll go through a little bit in the next slide around what it is. Effectively, you correct the errors, and separately, you obviously update your process and use automation or however you do that to make sure you don't have those issues again. In terms of the voluntary disclosure, that's obviously a lot more formal, and it's not the case that you want to do formal voluntary disclosure, you're allowed to do one and you get the reduced penalties. You still need to meet certain criteria. So those would include not being under a current audit or not having questions raised to you by IRAS at the moment. IRAS aren't aware of it. And you also must not have done a voluntary disclosure in the recent past. Not a formal requirement, but I suspect that's a requirement that's required. And you also have to show how you identified the issues, the shortfalls, what you've done to mitigate that going forwards. And then you can go down that voluntary disclosure. IRAS will agree the amounts and you can pay reduced penalties as a result of that. So going on to just the simple amendments, I'm not going to go through the slide in great detail. You can do it for the current year, maybe a couple of previous years. As I said, you do expose yourselves to slightly higher penalties. And I guess the more important part is you're probably raising a flag that you're making amendments to your year-end forms. So if you're making amendments, have you done everything? Should IRAS inquire and ask further questions to see whether there are further errors that have been missed? So those are the things that you might want to consider. And obviously, the more people that covers, the more items that are changed, and the more years that are involved, the higher that risk probably is. So as this one goes in a bit more detail, if you've got more risk, I would always suggest considering a voluntary disclosure. It may be for you, it may not be for you, but there are certainly benefits of going through it. A lot of companies, as we saw in the poll, do go through voluntary disclosures, and we do have companies that go through multiple voluntary disclosures for various reasons. So I guess one question that a client always asks me is, before deciding whether to do a voluntary disclosure or even amending or not amending historic returns, is how would IRAS know? Because if they can't find out, why should I respond? Unethical, maybe not the best thing to do, but it's a question that's asked to us. And we've outlined 4 areas that we have seen in the recent past. So there may be more, but these are the 4 areas that we've realised. Sometimes IRAS will write to management of companies or issue letters to companies asking them whether they've specific questions. And this could be from other data points that they've received. And obviously, as IRAS gets more sophisticated, they have more data points, more likely to ask questions. So one of our clients recently who approached us said, we claimed some deductions around employee benefits in our corporate tax return. And then IRAS, as part of the corporate return, asked questions to determine whether they're deductible or not. But then they've started asking questions whether we've reported it on the employer return. And so we're currently going through that with them to identify if there is an issue, whether they should address it, and whether there is a further review that's required. Another one that we've seen is routine checks. Sometimes companies receive questionnaires, and that could go to your boss or to the CEO. And in a later slide, I'll say, don't necessarily respond immediately, because we've had bosses respond saying, yes, we're aware of the rules, and then pass the letter on to an HR or payroll, and the HR payroll go, we've not done it correctly though. And that could cause you issues if you want to do down a voluntary disclosure. The industry specific one was one that Rayon touched on. One of our airline clients effectively was asked the specific question, around whether they provided travel benefits. And we understand from IRAS that this was an industry-specific question that they approached probably a number of airlines, because as we all know, if you have friends working in the airline industry, they usually get free flights or discounted flights. So whether those are being picked up correctly. So we do see industry-specific questions triggered from time to time. The last two, I'm not going to go in great detail. Obviously, if you report benefits on IR8s, you already give information to IRAS. They may ask further questions or compare year on year what benefits are being reported. And then the last one is if you call IRAS or if your employees call IRAS around treatment, then they have data points to ask further questions as well. So something to bear in mind. I'm not discouraging you to ask IRAS to get the answer, but just making you aware that that could be information that you're sharing with IRAS, either yourself or employees. So if you receive any communication from IRAS or you realize that you've done something wrong, as I said earlier, don't necessarily rush to reply to IRAS or rush to ask questions. Understand what they are actually asking you. You can go and respond saying, thanks, we've received it, we'll come back to you, but don't say, yes, we know the rules, when you may not have done it correctly. And then obviously speak to an advisor, do an assessment. It's an opportunity to do a full-on health check because you are coming clean for the bits that they haven't asked, but something to take seriously and not to ignore. With that, we've taken about 45 minutes of your time, just over, and we've gone through what we really wanted to look through, and we will open it up to questions. I did see a number of people raise their hand at certain points, so if you wanted to ask a question, feel free to type it in the Q&A piece. And I think we have one question from Eugene, which we will answer. What about health insurance? Is that considered a benefit in kind? I'm going to ask Ryan.
So Eugene, I guess when you talk about health insurance, I'm thinking and you're probably talking about medical insurance, right? So if you're talking about things like medical insurance that you provide to your employees, there's a general concession that this is not taxable. It's a benefit. Okay, so let's take it. What's the simplest way to say it? To explain is anything that you pay and provide, okay, to your employees are taxable in the first place, okay, but there are concession and exemption in place that, well, certain benefits, because this is IRAS decision that, well, given that this is for you to benefit your employees, it's something that they think is good for the employees to have, for example, medical, okay, there is a concession. Okay, so for medical benefits or for medical insurance, generally they are not taxed. It's a benefit, but it's not a taxable benefit. So hopefully that answers your question.
I'll just add to that. It's not taxable if it's a group medical insurance plan and it's available to all. So I do come across a lot where some individuals have private medical plans and those are generally taxable. So just to be careful of that. And it has to be available to all. So if you have a plan that's only available to a select number of people, then it's going to be taxable for that select number of people. Doesn't mean that you have to have the same plan for everyone. You can have a plan or different plans which cater for different groups of people. So you could have your senior people have a more comprehensive coverage and the wider firm having a less comprehensive coverage. But as Ryan said, generally taxable, everything's taxable, but because this is a nice to have, IRAS have relaxed the tax rules specifically for this. This is not in legislation, this is specifically for under concession by the IRAS. I will wait a little bit because I know that there's questions being raised in the chat box, not the Q&A box, and I can't see the chat box, but do you want to show me the chat box and I can just take it off there? Or do you want to wait for them to type it?
So okay, so one of the questions that has been sent to us is, if you extend advances to directors, you deduct it from their monthly salary, but they're spending more than what is their salary. Is this a loan? I am not quite sure if I understand it correctly, but I'm just trying to phrase it to see if this is correct. Is the company gives salary advances to your director, okay, and every month you deduct the advance from the salary, and obviously they need money to spend, so they say don't deduct all of my salary, and then that amount keeps rolling, right? So if that's the case, okay, I guess we probably need to have a discussion separately just to understand how are things being done, because otherwise, we probably won't have enough details to give further comments on this actually.
But at first glance, it sounds like a loan, it smells like a loan, it smells like you've paid something on their behalf or you've given them amount, which is not due to them yet.
Yeah.
And so it sounds like a loan, so you may want to look into that in a bit more detail.
Yeah. But the thing is, and the frequency of the repayment, is it on a monthly basis or how is that all structured? We probably need a bit more details on this. All right. Thank you for the question though. So yeah, we will be sharing our contact details so you can actually, okay. I guess we probably need to have a chat.
Yeah, maybe we have a chat.
Yeah.
I'm not entirely sure what you're trying to communicate. They incur personal advances, which suggests that they are getting an advance for the company for their personal expenditure, and then they want you to deduct it from the monthly salary. So, depending on the nature of that and the timing, there is a risk that that is a loan, because in the other chat there was a comment about that their spending is more than their salary. So I'm still trying to understand how that all pieces together. So maybe if you can share a bit more information over email or contact us, we can have a talk about it. But in essence, if they have taken money, probably not the right phrasing, if they have spent money which the company has borne on their behalf in excess of what they're due, and they receive that payment or they pay that back to the company at a later date, it sounds like a loan to me. So probably something to consider and look at, and you may be able to argue it's not a loan, but we'll need to have a bit more information around that to decide. Okay, so we've got another question around D&D. That's if a prize winner is taxable if they receive a travel voucher of $2,000. I think I'll answer the first part and I'll let Ryan give you the detail, but when you say it's taxable to the employer or employee, it's an employee benefit. So if there is tax, it's due on the employee. The employer, we're not like other countries like Australia, where you have a fringe benefit tax, where the fringe benefit is taxable on the employer. In Singapore, any profit or gain from employment is taxed on the employee, subject to concessions and exemptions. So yeah, is a travel voucher of $2,000 exempt?
Okay, so travel voucher $2,000 has always been the top price for a lot of companies that I've known. So one of the highlights for a lot of D&Ds is always the first prize, and for a period of time it was all the iPads. Then afterwards it's all, and a lot of companies provide or put their first prize as travel vouchers. It's always around this amount, $2,000. So IRAS guidance on lucky draw at D&D, not taxable. Okay, so hopefully that answer your question, Yan Kwan. Yeah.
Yeah, I'm just going to add to that. Vouchers are an interesting one from a CPF perspective, because vouchers are not subject to CPF. But if you said you're going to give them $2,000 of cash, then even though it may not be taxable, it would be subject to CPF. So it's just something to bear in mind, which is similar to red packets. Okay, with that, I don't think we've got any other questions. If you still have questions in the middle of typing, apologies, we're going to close the webinar now. But do feel free to contact us if you have any more questions. And thank you very much for listening.